Okay, good afternoon. Am I audible? Pawan, hello Pawan. Please respond. How many students are there? Okay. Okay, I am Ms. Rasmirekha Sahu, Assistant Professor of Commerce. I will take your subject Management Accounting, subject code BCOE-142. Okay. Today we will discuss block 1. There is Management Accounting, Introduction and Basic Techniques. There are 5 blocks in your syllabus, and in each block there are 4 units. We will discuss each one by one. Okay. The first, we will discuss about management accounting. What is management accounting, and what are the advantages? What is the basic objectives of management accounting, etc. Then unit 2, there is cost control, cost reduction, and cost management. That is related to cost specifications and types of cost, etc. We will discuss in unit 2. And there is financial statements in unit 3, and unit 4 contains techniques of financial analysis. Okay, first, today we will discuss block 1, that is management accounting. So students, before discussing management accounting, we have to understand what is accounting first. Okay, you people have some idea about what accounting. I think you know about accounting, what is called accounting. So accounting means it is very simple. It is a process of recording the financial transactions on daily basis in a business organization or in a company, whatever may be the business, may be small or big. The accounting, the process of accounting, it only records the transactions in a day-to-day basis. So in accounting, we only know about the financial position. Okay, financial position. What is the position of the profit and loss account, and what is the position of the balance sheet, etc. But if there is some difficulties arises, or if there is some issues arises in our balance sheet or in our profit and loss account, or there may be some issues arises in our financial position of our company or business, in that case we have to analyze the financial statements very properly in order to overcome those problems. So basically in management accounting, we study about various informations what are included in the financial accounting, their planning, decision making, and the performance evaluation, control, management of cost, etc. So if you discuss what is management accounting, first I will tell you the meaning of management accounting is that it is a field of accounting which deals with basically providing the information, including financial accounting information, to the managers for their use in planning, decision making, performance evaluation, control, management of cost, and cost determination of financial reporting, etc. So in management accounting, we have to analyze the financial statements, whether the profit and loss account or the balance sheet. We have to analyze the performance of the financial position of an organization. Okay, if any issues arises, or if there is any imbalances in our profit and loss account or balance sheet, then we have to adjust them accordingly, and we have to control them. Okay, we have to take corrective measures. So basically in management accounting, we will study these basic things by which we can control the financial position, and we can strengthen the financial position of an organization efficiently. Okay, so here one definition is there. According to CIMA UK, defines the term management accounting as it is an integral part of management concerned with identifying, presenting, and interpreting Interpreting the information. What are the basic informations are there? First, formulating strategy. If any strategy will be formulated, then we can take the help of management accounting, or with the help of management accounting, basically the plans and strategies can be formulated in an organization. Then second one, we can also function the planning functions and controlling activities. It also helps in case of decision making. Also, it helps in optimizing the use of resources, disclosure to shareholders and other external to the entity. Then next, disclosure to employees. And last point is safeguarding the assets. Okay, so the role of management accounting is very crucial for an organization. It helps the organization in different directions, from different angles. First of all, it helps us to formulate the various strategies and plans for the implementation of various plans in an organization. It also helps the managers to take decisions, and also it helps one organization to use the resources in an efficient manner, by which we can use the resources efficiently. Okay. Then we will discuss, so these are the basic definitions and the meaning of management accounting. I think you may have some idea about what is management accounting and why management accounting is necessary for a business organization. Okay, so management accounting includes various scope by which we can study the financial position of an organization. So there may be a question in your mind, how management accounting is necessary for an organization. Okay, so from management accounting, there are so many techniques are used by which one can analyze the financial position of an organization. It not only helps the business organizations to strengthen its financial positions, it also helps the outsiders. They are the creditors, okay, the shareholders, or even if the customers. It can be also helpful for them to assess the financial position of a particular organization. The shareholders may have interest to know about the financial position of an organization because they are investing their money in that particular organization. So, in this way, management accounting helps an organization to take various important decisions, and also to strengthen its financial positions, and also take various necessary steps if there may be any problem in its financial position. Okay, so there are various scopes of financial positions. First, if you will discuss the scopes, there are budgeting, planning, forecasting. Management helps in budgeting. In case of planning, forecasting, it also helps in calculating the profitability of products, measuring organizational, divisional and departmental performance, comparing the results and performance within and between the organizations, assisting in the process of increasing effectiveness and efficiency, assessing the performance of past and future capital investment, then also advising on decisions about product mix, market, etc. So there are so many scopes, but here we will discuss a few of them. Okay. So basically, management accounting helps us in analyzing the financial position of an organization. At the same time, it also helps in formulating various strategies and planning and implementation of various strategies in an organization. Okay. Then next, in order to perform the management accounting, or in order to implement the management accounting in an organization efficiently, we have to take the help of various management functions basically. So basically there are mainly 4 types of management functions which may be included in case of implementing the management accounting in an organization. Mainly, if we discuss about them, there is planning, organizing, controlling, decision making are the main 4 important management functions by which we can implement the management accounting system in an organization very efficiently. You may have some idea about planning, organizing, controlling and decision making. Planning is nothing. It is only for formulating short-term and long-term plans and actions in a organization for a particular time period. And organizing is the process of establishing an organizational framework, and assigning the responsibility to people working in an organization for achieving business goals and objectives. Okay. Then we will come to controlling. Controlling is nothing. It is the process of monitoring, measuring, and evaluating the performance what already have done in an organization. Okay. And finally, the fourth function will come, that is called decision making. After planning, organizing, and controlling, decision making process will come. In this case, it may help the manager to take various relevant decisions relating to an organization. So decision making is very important because if you will not take sound decisions, then it may hamper the profitability positions of our organizations. So these are the basic management functions which helps the manager who helps an business organization to implement management accounting in an organization. Okay. Understand? Okay. Then we will come to cost. Okay, cost control unit 2. You will go through the limitations and functions also. If there is any doubt, you can ask me. Okay, there are so many limitations also. The management accounting has the mainly the basic limitations are there. Okay. So if we discuss about the limitations of management accounting, before we have to also know about why management accounting has come. Okay, what are the basic limitations of financial accounting? In order to overcome the limitations of financial accounting, management accounting have come. Okay. Then we will come to unit 2, that is cost control, cost reduction, and cost management. Okay. So before discussing about cost control, we have to know what is cost first. Okay. So cost is nothing. Cost is only the amount of expenditure which we have actually incurred relating to an object. Okay. For example, at the time when we purchase any product or services, we have to pay some price for that. That is called the cost of a particular product or object. The cost of the object is any item such as products that may be customers, departments, projects, activities, and on, for which costs are measured and assigned. For example, if a bank wants to determine the cost of a credit card, then the cost object is the credit card and cost is the cash or cash equivalent value sacrificed to obtain some goods or services. So cost is nothing. It is a generic term which is defined as it is used in various ways so as to include all types of various types of costs. There are so many types of costs. So basically cost is nothing. It is an expenditure which we incur in order to obtain an object or product and services. There are so many types of costs basically. If you discuss mainly there will come deferred cost and expired cost. Okay, deferred cost and expired cost are same. Deferred cost is the cost which already have incurred, or the cost are unexpired cost which provide benefit in the future period. They are capitalized cost and known as asset and hence appear in the balance sheet. So deferred cost is nothing. It is the cost which has already been incurred. Okay. Then we will discuss various types of cost. If we discuss the cost, basically three types of cost will come to our mind. First is fixed cost, the next one is semi-fixed cost, and the another one is variable cost. Okay. So fixed cost is what? Fixed cost is that cost which remains constant irrespective of the level of production. Whatever may be the level of production, but the fixed cost will remain constant. Okay. If we will come to the variable cost, then it is just the opposite of fixed cost. Then what is variable cost? Variable cost is the cost which increases or decreases or which may varies according to the production level. Okay, if the production increases, then the variable cost will increases. But if the production decreases, then the variable cost will decrease. Okay. But in case of fixed cost, if the production increases, the fixed cost per unit will decrease. How? Because Suppose there is a fixed cost of rupees 1 lakh for 100 units of product. Okay. If the production increases to 200 units, then the fixed cost per unit will decrease. How? Because that total amount of fixed cost, when there are 100 products, that total amount of fixed cost will be divided between the 100 products, among the 100 products. But when the production level increases, there are 200 products, then the fixed cost will be distributed among 200 products. So the fixed cost will automatically decrease, and we know the fixed cost will remain constant irrespective of the level of production. Okay. For example, the rent of a factory building, or the salary of a watchman, or the salary of a supervisor, they will remain constant whatever may be the production level. Okay. So if you discuss various different cost concepts and classifications, then first we will discuss first according to the traditional point of view, the cost may be direct material cost, direct labor cost, direct expenses cost, factory overhead cost, selling and distribution, and administrative cost. Okay, if we discuss from traditional point of view, there are mainly 5 types of cost. Direct material cost is what? Direct material cost is the cost which includes the cost of all the direct materials which are used to produce the original product. Okay, it is the cost of material which becomes the major part of the finished product. Basically, the cost of the raw materials, and they are the basic part of a finished product. These are called the direct material cost. Okay, then direct labor cost is like also direct material cost. Direct labor cost is also the cost the workers who are engaged indirectly in the production process to produce that particular product. That is called the direct labor cost. So the cost incurred to produce a particular product in the production process, and the laborers who are engaged themselves to produce a particular product in an organization directly, that cost of the labor is called direct labor cost. It is the labor cost for specific work performed on products that is conveniently and economically traceable to end products. Okay. Then like that, the direct expenses is also like that. The expenses which are incurred directly for the production of a particular product, that is called direct expenses cost. Then we will come to the factory overhead cost. Factory overhead cost is what? Factory overhead cost is the cost which are mainly called the manufacturing expenses. Okay, at the time of manufacturing, the expenses which are incurred, that cost is called the factory overhead cost. Okay. So, for example, what are mainly the factory overhead cost? Suppose at the time of production, we may use some basic production things like cotton, okay, lubricant oils, okay. These are called the factory expenses. At the time of production, these are the basic things which a labor will use at the time of producing a particular product. So these are called the factory expenses and also called factory overhead or the factory cost. So the factory cost or the factory overhead cost mainly included in the prime cost. Okay. Then last one, from the traditional point of view, the last cost is selling and distribution and administrative overhead cost. So selling and distribution cost are the cost which are incurred at the time of selling or distribution expenses. For example, the advertisement expenses, the packaging expenses, these are called the selling and distribution cost. And from the point of cost of behavior, that is fixed cost, variable cost, and mixed cost, that is also called semi-variable and semi-fixed cost. We have already discussed about this. Semi-variable cost or semi-fixed cost is what? Semi-variable cost is that cost where part of the cost is fixed and part of the cost is variable. Okay. Then from the degree of traceability, the cost object is direct cost and indirect cost. And the time of charges, there may be product cost, period cost. And if you consider from the management function, there are manufacturing cost, selling and distribution cost, administrative cost. Okay. If you discuss the accounting period, there are mainly 2 types of cost, capital cost and revenue cost. Then we will come to the cost for decision making and planning. Okay. If we will discuss the cost from decision making and planning, there are so many costs, but basically the costs which are used, which are mainly play a important role in an organization, these are basically the opportunity cost, sunk cost, okay, then the relevant cost, differential cost, then there may be the imputed cost, out of pocket cost and shutdown cost, fixed and variable cost, direct cost and indirect cost. So what is opportunity cost? Opportunity cost is the cost of opportunity loss. Okay. So it is basically an opportunity cost is the benefit given up or sacrificed when one alternative is chosen over another. If we have two alternatives, but we will choose one alternative. At the same time, we have to sacrifice another alternative. Okay. So, so that is called the opportunity cost when one alternative is chosen over another alternative. It is the income foregone by selecting another alternative. So an opportunity cost is the net cash inflow that could be obtained if the resources committed to one action were used in the most desirable other alternative. Okay. So basically, if the opportunity costs are playing a very important role in decision making and evaluating the alternative proposals of an organization. If there are two alternatives, we have to choose the best alternatives by which we can obtain maximum profit. Okay. Then we will come to the sunk cost. Sunk cost is what? Sunk cost is the cost that already has been incurred. It is also called historical cost. Okay. The sunk cost is the cost which already been incurred or committed the cost. So sunk cost cannot be changed once they have been incurred and cannot be avoided by any decisions that is made in the future. If the sunk cost is that type of cost, if the cost have already been incurred, then there cannot be any alternation. Okay. So any asset obtained from the incurred cost can be used or sold, but its value is its present or future value. Okay. Then we will come to the relevant cost. Relevant costs are those costs which plays a relevant role for the future cost. Okay, which differs between alternatives. And relevant cost may also be defined as the cost which are affected and changed by a decision. If a cost increases, decreases, appears or disappears as different alternatives are compared. So relevant costs are only the future cost, those costs which are expected to be incurred in future. Relevant costs therefore are not historic costs which have already been incurred and cannot be changed by a decision. Okay, got it? Any doubt about opportunity cost, relevant cost and sunk cost? Okay, then we will come to the differential cost. So what is differential cost? Differential cost is the difference in the total cost between any two alternatives. Okay, so differential costs are equal to the additional variables expenses incurred in respect of the additional output plus the increase in fixed cost, if any. It means that differential cost is the only difference in the amount of the two costs. Okay, this cost may be calculated by taking the total cost of the production or without the additional contemplated output or comparing it with the total cost incurred if the extra output is undertaken. Okay. We will discuss it, then we will come to the imputed cost. Imputed cost is that cost which not actually incurred in some transactions but which are relevant to the decisions as they pertain to a particular situation. Okay, it has not actually been incurred, but it has some influence or it has some impact, and it may play a relevant role to the decisions as they pertain to a particular situation. These costs do not enter into traditional accounting system, but they being related with economic reality. Okay. So then we will come to the out-of-pocket cost. Out-of-pocket cost is what? While imputed costs do not involve cash outlays, out-of-pocket cost signifies the cash cost associated with the activity. Non-cash costs such as depreciation are not included in out-of-pocket cost. Okay, out-of-pocket means the cash which it only includes the cost which incurred some cash expenses. The non-cash costs are not included in this type of cost. For example, the depreciation is a non-cash cost. It will not be included in the out-of-pocket cash cost. Okay. Then the last one is the shutdown cost. Shutdown cost is what? Shutdown cost are the cost which have to be incurred under all situations in case of stopping manufacture of a product or closing down of a department or division. Shutdown costs are always fixed cost. If the manufacturing of a product is stopped, variable costs like direct material, direct labor, direct expenses, variable factory overhead will not be incurred. But the shutdown cost is that part of cost which will incur whether the production process will be stopped or not. Okay. Then from the control point of view, there are two types of cost. If we consider from the control point of view, two types of cost, that is controllable cost and uncontrollable cost. The controllable cost is that cost which can be controlled or which can be influenced by taking some basic steps within our organizations. But uncontrollable cost, we cannot control that cost because some external factors influence that particular cost. So the concept of controllable cost is what? It is very important in cost accounting and contributes effectively to the achievement of various objectives of cost control and responsibility accounting. So according to ICMA, it defines the controllable cost as a cost which can be influenced by the action of a specified number of an undertaking, and a non-controllable cost as a cost which cannot be influenced by the action of a specified member of an undertaking. Okay. For example, if you take an example, the controllable and non-controllable cost are suppose consider a plant supervisor. This individual influence labor and material cost by scheduling workers and assuring an efficient production process. Thus, labor and material cost are a supervisor's controllable cost. However, the supervisor cannot determine insurance for a plant, but a plant manager or an insurance specialist makes decisions regarding insurance. Therefore, insurance cost is a supervisor's non-controllable cost, but a plant manager or an insurance specialist controllable cost. Okay, clear? Then there may be standard cost, joint cost, common cost. There are so many costs in cost concept. Okay. Any doubt? If any doubt, then you can ask me. I will clarify your doubt. Okay. Then we will come to the financial statement analysis. So before we discuss about financial statement analysis, we discuss the financial statements. What are the financial statements in an organization, and how we can analyze them. Okay. So there are mainly, we know in accounting, we know there are mainly three types of financial statements. Okay. First, we have to prepare the trading account, then the profit and loss account, and lastly the balance sheet. Okay. So in trading account, we only take the direct expenses and the incomes. Okay. From the trading account, we get the gross profit or gross loss. Then we will come to the profit and loss account. The gross profit or the gross loss will be carried forward to the profit and loss account, and there various types of indirect expenses are recorded. Okay. So from the profit and loss account, we will get the net profit or net loss. Okay. Then finally, we have to prepare the balance sheet. The balance sheet mainly includes the assets and liabilities of the company or the organization. Can you understand? Am I audible? Hello? Okay. So these are mainly the basic financial statements in an organization. Okay. First one is the trading account. The second one is the profit and loss account, and the third one is the balance sheet. We have already read them about in financial accounting. And besides them, there are also one statement, that is the cash flow statement. Okay, cash flow statement are there. So we have to understand the financial statements very thoroughly. Then first the trading account, then the profit and loss account, then the balance sheet. If we discuss about the financial accounting, then there mainly comes these account: the profit and loss account, trading account, financial statements, and lastly the balance sheet. Okay, the balance sheet plays a very important role in for a organization, for a business organization, because from the balance sheet we can gain a basic idea about the financial position of the organization, because how the balance sheet includes all types of assets and liabilities of an organization. So we can gain a basic idea about the debt and equity capital of an organization from the balance sheet particularly. Okay, we can analyze the debt position, the equity positions, also the assets positions, the current liabilities, what are the current assets. Okay, we can gain some basic ideas from the balance sheet. So the analysis of a balance sheet plays a very important role for an organization. So there are so many techniques of financial analysis. First, we understand what is the financial statements, okay, and how we can analyze them thoroughly. So if we come to the financial statements, the financial statement is what? It is nothing. It is an analysis. The financial statement is a statement which depicts or picturizes the financial position of an organization. Okay, the financial position of an organization. It mainly includes the trading account, profit and loss account, and the balance sheet. And there also the cash flow statement may be included in the financial statements. Okay. We have already discussed about the trading account, profit and loss account. The trading account includes basically the direct expenses. Then there the profit and loss accounts from which we can get the net profit or net loss of an organization. Okay, and from the balance sheet we can gain a very basic idea about the financial position of an organization. Okay. So from the financial statement, we can know the financial position of an organization. But why the financial statement analysis is needed? Because only from the financial statements we can get the basic information about various financial current assets, current liabilities, then your fixed assets, debt and capital, equity capital, debt positions. We can only get the information, so what are the position of them, but we can't, and if we don't analyze them, then we can't take necessary steps to improve the financial position of an organization. If, for example, if an organization suffers losses for 5 years continuously, okay, then we have to take some necessary steps, some necessary measures in order to minimize the loss, or in order to make them more profitable for that particular organization. So in that case, we have to analyze that financial statement very thoroughly. We have to take necessary steps by which we can strengthen the financial position of that particular organization. And if our financial positions will become weak, then the investors who invest in our company, they may withdraw their money from our company. Okay. So it is the basic duty of an organization or an business organizations to analyze the financial statements very frequently and take necessary measures in order to strengthen the financial position of an organization. So if we come, what is financial statement analysis is what? Financial statement analysis is an analysis which highlights important relationships in the financial statements. Okay. The relationship, what are the basic relationships can be established with the financial statements. So financial statement analysis mainly embraces the methods used in assessing and interpreting the result of past performance and current financial positions as they relate to a particular factor of interest in investment decision. Okay, the financial statement analysis not only shows the current positions, it also shows the past positions, the past performance of an organization, and it also relates the current financial positions with the past performance and compare the current financial position with the past performance of the organizations. And if there are any necessary steps should be taken, then we can know from the financial statement analysis which steps are required to be taken. Okay, so it is an important means of assessing the past performance and forecasting and planning future performance. So basically, from the financial statement analysis, we can assess the financial position of an organization as well as the past performance, and also we can forecast and we can take some basic decisions and we can make plans for the future performance of an organization. So financial statement analysis is an information processing system designed to provide data for decision making models such as the portfolio selection model, bank lending decision models, and corporate financial management models. Okay. So why we will analyze the financial statements of an organization? Okay, the financial statement analysis is very much necessary for an organization, because we don't analyze the financial statements, only we prepare them year after year, but we don't analyze them, then we cannot get the weak point and the strong point of our organizations. We cannot get the inefficiency positions of our organizations. Okay, if we analyze them regularly, then we can point out the strong the positions. If there are some maybe any weakness, then corrective measures can be taken. We can spot out them. Okay. So the major objectives of financial statement analysis is to provide decision makers information and also about the business enterprise for use in decision making, which can be used for decision making. Users of financial statement information are the decision makers concerned with evaluating the economic situation of the firm and predicting its future course. Okay, so I have told you from the very beginning that the financial statement analysis, or in order to know the financial positions of an organization, is not only helpful for the business organization itself. Okay, it is also helpful for the outsiders. The outsiders are mainly include the creditors. Okay, and the equity shareholders, the preference shareholders. The equity shareholders are the they have the ownership right of the organization, so they have every right to know about the financial position of an organization. So if you don't analyze them regularly, then they cannot get efficient information about the financial position of an organization. So they must have interest to know about the financial position of an organization, because they have invested their money in our organization or in a particular company. So in the company in which they have invested their money, they have all the right to know about the financial position of that particular organization. Okay. So it will also be helpful for the creditors, for the shareholders, as well as for the banks. If the company took some loans from a particular bank, then they may have interest to know about the financial position of an organization. So mainly the basic objectives of financial statement analysis are: first, the assessment of past performance and current positions. Okay, the second one is prediction of net income and growth prospects. And it also may be helpful for an organization for predicting of a bankruptcy and failure, and also loan decision by financial institutions and banks. We have already discussed about them for assessing the past performance and also current position, and also for forecasting the future. Okay, to take any future decisions, the financial statement analysis will always help one organization or one company. Okay, and also for predicting the net income and growth prospects also, the financial statement analysis also helps in that case. Prediction of bankruptcy or failure. Okay, financial statement analysis is a significant tool in predicting the bankruptcy and failure probability of any business organization. If there may be any chance for the failure of the business organization, then it may take necessary measures, so it may be careful to avoid that particular loss. Okay, so corporate management can affect changes in operating policy, reorganize financial structure, or even go for voluntary liquidation to shorten the length of the time of losses. Okay, Then the last objective here is what? The loan decision by financial institutions and banks. If we go some, if we come to in case of the financial institutions, and if you need some loan to expand our business or to for the further investment in our business, then if we don't have sufficient fund, then we go to a financial institution from which we can get some loan. Okay, so the financial statement analysis is also used by the financial institutions, loaning agencies, banks, and others to make sound loans or credit decisions. In this way, they can make proper allocation of credit among the different borrowers. So financial statement analysis helps in determining the credit risks, deciding terms and conditions of loans, if sanctioned, interest rate, maturity date, etc. Okay. If you have any doubt, you can ask me. Okay. So these are the basic objectives why we will analyze the financial statement of an organization. Then we will discuss the various techniques of financial analysis. What are the basic techniques for the financial statement analysis? There are mainly four techniques are there in order to analyze the financial statements. These are the first one is the horizontal analysis, then the vertical analysis, then trend analysis, and then ratio analysis. Okay. So what is horizontal analysis? Horizontal analysis is what? It is the percentage analysis of increase and decrease in corresponding items in comparative financial statements is called horizontal analysis. So in horizontal analysis, in case of financial statements analysis, there will be two statements. Okay. Suppose, for example, the financial statement of 2007 and 2008 are there, and they will ask you to analyze both the financial statements of 2007 and 2008. Okay. For example, in 2008, in the balance sheet of 2008, there are various current assets, current liabilities, fixed assets, and fixed liabilities are there. And in 2008 also, same the current assets, various current liabilities, debt, equity capital, marketable securities will be there. You have to compare between these two balance sheet, the balance sheet of 2007 and the balance sheet of 2008. What are the increases and decreases in corresponding items? Suppose in the balance sheet of 2007, the amount of current asset is 10,000, and in the balance sheet of 2008, the amount of current asset is 15,000. Then the difference will be 5,000, and you have to compare with them in percentage basis. Okay. So it is nothing. The horizontal analysis is the percentage analysis of increase and decrease in corresponding items in comparative financial statement. That is called horizontal analysis. Horizontal analysis involves the computation of amount changes and percentage changes from the previous to the current year. You have to compare two balance sheets. Okay. With the previous balance sheet and the previous balance sheet and the current year balance sheets will be there. You have to compare between the two balance sheets. When the comparison is made between two statements, the earlier statements is used as the base year. Okay. When the comparison is between two statements, suppose in 2007 and 2008, then you have to take 2007 as the base year, because that is the earlier statement. Okay. So the percentage change, how you can calculate the percentage change? That will be amount of change divided by the previous year amount into 100. Okay. Okay, then we will come to the vertical analysis. Vertical analysis is what? It uses the percentage to show the relationship of the different parts to the total in a single statement. Vertical analysis says a total figure in the statement equal to 100% and compute the percentage of each component of that figure. Okay. So in vertical analysis, we have to take the total figure as equal to 100% and compute the percentage of each component in that figure. The figure to be used as 100% will be total assets or total liabilities and equity capital in the case of balance sheet, or revenue or sales in the case of profit and loss account. Okay. Any doubt? Okay.
No, ma'am. No doubt, ma'am.
If you have any doubt, then you can ask me. Okay. And also do the problems. There are in your IGNO material, there are some problems. You have to solve them. If any doubt arises, then you can ask me in the next class.
Ma'am,
Okay.
ma'am,
Yes.
materials not yet received, ma'am.
There is a website that is called eGancos something. There are the IGNO materials are available there. You can
Okay, ma'am.
download from that particular site. Okay. In
Okay.
Google, if you search them, or otherwise you can follow the basic fundamentals books of management accounting, which the BCom students are following. Okay.
Okay,
Uh,
ma'am.
which publisher you can follow? There are so many publications in the market. You can follow one of them, and in your syllabus, what are there in that particular book, you can find everything. Okay.
Okay,
And
ma'am.
still, if you have any doubt, then you can ask me.
Okay, ma'am. Ma'am,
I will
only in
clarify
next
your
class.
doubt. Your next class, I will take your class. What are the subjects you have?
Ma'am, management
You
accounting,
are
financial
you are
management.
become third year, right?
Yes, ma'am.
Yes, management accounting, and there are your tell your subjects. I will take your management accounting BCOE 142 code. Okay,
Yes, ma'am.
and also I will take the BCOE 144, that is the office management and secretarial practice.
Okay, ma'am.
That chapter is there in your syllabus.
Yes, ma'am. There, ma'am.
Yes,
Secretarial
I will
practice
take
is
that
there.
class also. I will take, but tomorrow I will take, and the subject, the Indian economy and principles of microeconomics.
Yes,
These
ma'am.
subjects,
That is also
these
there,
subjects
ma'am.
are also in their syllabus.
Yes, ma'am.
Yes, okay. You are become third year, and which semester you are going to appear?
Our annual base, ma'am.
Uh, I can't hear.
Our exam is annual base, ma'am. We have to appear
Annual
exam in
batch.
June.
Okay, okay. Annual batch. Okay, these subjects are there in your syllabus: Indian economy, principles of microeconomics,
Yes,
then
ma'am.
management accounting, and your office management. Okay, I will take these
Yes.
four subjects. Okay,
Okay.
today is your management accounting, and on Sunday also there is one class for management accounting. Okay, I think the
Okay.
timetable will be shared with you people.
Yes, ma'am. Said, ma'am.
Yes, yes, okay. I will take the next class of management accounting on Sunday, and
Okay.
tomorrow I will take three classes: office management and microeconomics and Indian economy. Okay.
Yes. Ma'am.
We will. There are so less classes are allotted. So if you have any doubt, you can ask me, or you can contact me in WhatsApp also. Okay.
मैम आपका व्हाट्सएप नंबर मैम
Yes, yes. Note down my WhatsApp number: 8763
8763
27
27
9770.
9770.
You are
Okay,
the
ma'am.
only student joined,
Yes, ma'am. I think
right?
no one have means received this
Okay.
notice.
Okay, no worries. Okay.
Okay,
Okay,
ma'am.
tomorrow you will attend.
Okay, ma'am.
There are three classes. Okay. I will clarify your doubt. You can ask me whether you have any doubt, and I will provide you the material, whatever material I have. Okay.
Okay, ma'am.
Yes.
Ma'am,
Then we will come
recording
to
of this class will be available or not, ma'am?
recording of this class. Will not be available with me. Okay.
Okay.
I think it will be available from the IGNO. Okay.
Okay,
Don't know.
ma'am.
You can ask me your doubt at any time. Okay.
Okay,
Then
ma'am.
we will come to the trend analysis. Trend analysis is what? Using the previous year's data of a business enterprise, trend analysis. Trend means there are 3 to 4 years data will be there. Okay. There may be year 1, year 2, year 3, year 4. There will be data for continuous 3 to 4 years. You have to analyze the data of those particular years. Okay, it will be on a trend basis. Okay, so the previous year data, you have to use the previous year data of the business enterprise. Trend analysis can be done to observe percentage changes over time in selected data. In trend analysis, percentage changes are calculated for several successive years instead of between 2 years. Okay, here you can see, I will share the photo. Okay, just a minute. Look at this. Is it
Hmm.
visible?
Yes, ma'am, it's visible.
Yes. Okay. See. So trend analysis, what we have to using the previous year data for the business. There are see, there are 3 to 5 years data are there. Year 1, year 2, year 3, year 4, and year 5. Okay.
Yes,
The data of sales and net earnings. You
yes.
have to use this 4 to 5 years data and compare these data with year 1 with year 2 and year 3, like this. Okay.
Okay, ma'am.
I will share the material. Okay. Then, these are the data year 1, year 2, year 3, year 4, year 5. You have to analyze them by using an index number over a period of time, and the index number may be 1 year. The base year is equal to 100%. You have to go through the problems. There are so many problems in your IGNOU material also. So you can follow some basic books. Okay. So like this, you can determine the financial position, or you can analyze one financial statements by using the trend analysis. Okay.
Okay, ma'am.
It is trend analysis is nothing, but it is the previous year's data of a. You have to use the previous year's data of a business enterprise. Okay, in order to calculate or in order to analyze the financial statement. The trend analysis can be done to observe percentage changes over time in a scheduled data. Okay, the trend analysis is only used to observe the percentage changes over a time in a selected data. Okay, are you Odia or non-Odia?
I can understand Odia, Hindi, Telugu, and English, ma'am.
Okay. Then another one is, I think block 1 will be completed today. Okay.
Okay, ma'am.
You have to go thoroughly in with your material, because with this limited time we cannot go thoroughly.
Oh,
We have to discuss overall. We have to discuss, and you have to go thoroughly. If you have any doubt, you can ask in the next class. Okay.
okay, ma'am.
I will explain you. Then there is another analysis that is called ratio analysis. Okay, ratio analysis is what? It is an important means of expressing the relationship between two numbers. Okay, a ratio can be computed from any pair of numbers. We know the ratio can be computed. The ratio can only be calculated if there are a pair of numbers, right? In from one number we cannot calculate a ratio. There must be two numbers in order to calculate a ratio. So in case of ratio analysis, we have to analyze the financial statements by taking the current assets, current liabilities, okay, fixed assets, fixed liabilities, inventory, closing stock, opening stocks. These amounts will be used at the time of calculating ratio analysis. Okay, there are so
Okay,
many
ma'am.
ratios like current ratio, liquid ratio and current ratio are same. Then inventory turnover ratio, debt equity ratio. Okay, there
Yes,
are
ma'am.
so many ratios. You can calculate them from the balance sheet, from the balance sheet of a financial organization, from the current assets, from the current liabilities. You can take those amounts and calculate the particular ratio of that particular financial statement. So ratios are mainly the guides or shortcuts that are useful in evaluating the financial positions and operations of a company, and in comparing them to previous years or to other companies. The primary purpose of ratio is to point out areas for further investigation. They should be used in connection with a general understanding of a company. So these are the basic techniques of financial statement analysis. Among them, ratio analysis plays a very important role for the organization, because from ratio analysis we can be able to know about various important financial positions like debt equity ratio. What is the debt and equity positions of an organization? What are the inventory position of an organization? Okay, what is the current assets and current liabilities position of organizations? These various things we can get from the ratio analysis. Then there is also one statement analysis that is called, there are so many ratios. Okay, you have to go through them, like current ratio, cash ratio, quick ratio, capital turnover ratio, asset turnover ratio. There are so many ratios: net working capital turnover ratio, inventory turnover ratio, receivables turnover ratio, profitability ratio. Okay, net profit ratio, gross profit ratio, return on equity, return on capital employed. There are so many ratios which you can calculate from the financial statements, from the balance sheet of an organization. The information, the data will be in the balance sheet of an organization, and you can subtract them from the balance sheet, and by using those data you can calculate various types of ratios, and from that ratios you can be able to know the financial positions of a particular organization. Okay, so common size statements is what? Common size statements involve expressing comparisons in percentage. Common size statements may be prepared in order to compare percentage of a current period with past period, to compare individual business, or to compare one business with industry percentage published by trade associations and financial information services. So, which we have already discussed various techniques of financial analysis. There are the horizontal analysis, vertical analysis, trend analysis, ratio analysis, common size statements. Okay, these are the basic techniques of financial analysis. Here, basically, the past year's data and the current year data are there. We have to compare between the past year data with the current year data. Okay, from the past year and the current year data, we can calculate various ratios, and we can compare them by the help of vertical analysis, horizontal analysis, and by which we can know the financial position of a organization. Okay, if there may be some issues arises, like if the financial positions will be weaker, then we can take corrective measures, we can take basic necessary steps in order to avoid them. Okay, your block 1 is completed. If you have any doubt, then you can ask me. You have any doubt? Am I audible? Hello?
Go through the materials and I will ask in next class or by WhatsApp, ma'am.
Okay, okay. If you have any doubt, you can also ask me. Next class we will discuss about block 2. Okay.
Okay, ma'am.
Have you any friends who also joined in IGNO?
No, ma'am, in Delhi, ma'am. RC Delhi, I have friends.
Okay. Acha, why they are not attending the classes?
They
Oh,
belongs to RC Delhi, now, ma'am. I will share the links, ma'am. They will also attend.
okay, okay, fine. Okay.
Okay, ma'am.
Thank you.
Okay, ma'am.
We'll discuss in the next class. Okay.
Okay, ma'am.
Tomorrow you will have 3 classes. Okay.
Okay.
Thank you.
Thank you, ma'am.